In all crises, there are incredible investment opportunities that are created by the crisis. You have to have the capacity in a portfolio to step into those. And if you can't, it's painful to forego those opportunities.
How do you maintain that discipline when you see something that's cheap, but you're concerned it may just get cheaper?
I'm often adding risk in more volatile environments slowly. That will make sure that I have some exposure if the market decides to rally, as opposed to waiting for the perfect moment and then you completely miss it.
You were a relatively new analyst heading into the global financial crisis. Is it that time that gave you your biggest experience?
It was a jarring event, but I had my blinders on about the potential for severe volatility and drawdowns.
What could go wrong?
What could go wrong?
Today, we have Damien McCann joining us. Damien's a fixed income portfolio manager based in West Los Angeles and has been at Capital Group for 24 years. Welcome, Damien.
Thank you.
So, Damien, you went to Cal State Northridge, and when you were looking for a job initially, you were trying to distinguish yourself. And one of the ways you did that, and I'm going to come out of the gates fast today and show you from our little office treasure hunt, a CD from your office, and an old CD. And the CD says, for those listeners, Resume for Damien J. McCann, Objective, Financial Analyst. And there's a lot of fancy formulas on front. I'm not smart enough to know if those are real, but you don't know either. Either way, there are formulas on the front. And what is this? You obviously produced a CD as your resume.
Yep.
Why'd you do it? And tell us a little bit about how you started out in this business.
Yeah, so I had gone 0 for 50 with my traditional paper resume.
0 for 50.
0 for 50.
Which is a lot.
It was a bummer. So it was either get creative to be noticed or go back to working at the bowling alley.
And you didn't want to go back and work at the bowling alley.
Wasn't ready to do that.
Yeah.
So, I mean, the backstory was I went to Cal State Northridge. I initially was an accounting major, got tired of studying debits and credits, switched to finance. And this was the late 90s, so the dot-com era. And there was no shortage of interesting companies in the internet space to read about, and the market was hot. And so I got pulled into the market and knew that I wanted to work in investing somehow.
Mm-hmm.
Graduation was coming up. Wasn't sure how to get into the industry. Started out with that paper resume, heard nothing back, including from the Capital Group.
Crickets. Yep.
Crickets. So I decided I had a part-time job at the time doing some website development. So I knew a little bit about that. And I just had this idea to put my resume, make it a web page. And then I thought I could burn it on a CD and send it to all of the same companies. And I packaged it like AOL was packaging their CD-ROMs at the time in this Amaray case. So I sent one to Capital and like 50 other firms, and I had 5 interviews in a week.
Wow.
And interviewed with Capital, interviewed for an equity research associate position, was offered the job, took it, and I worked for about 5 years with 3 equity analysts.
It's a great lesson as well in terms of just advocating for yourself and trying something a little different as opposed to what everyone else is trying to get your foot in the door. I give you a lot of credit for that. I wouldn't have been that creative. So you mentioned you started in equities. Not a lot of folks switch from either fixed income to equities or equities to fixed income. You did. You're one of the few. Tell us a little bit about that transition of going from the stock market to the bond market.
Yeah, I mean, it actually wasn't my idea. So I had completed an investment review as an equity research associate because I wanted to become an analyst. And my project sponsor was an analyst named Kathy Kerr, who followed energy equities in today's CRGI, Capital Research Global Investors Group.
Mm-hmm.
And she had started out at Capital as a high yield analyst in our fixed income group. And so I think it was a combination of business need, and then she thought I would be a really good fit in fixed income. I didn't know. I felt like I knew nothing about the bond market, so it was kind of nerve-wracking. But I just decided to trust and to take the leap, and haven't looked back.
And how does that influence you now? So does having that time as an equity analyst, do you think you're a different fixed income investor because of that or not?
I do, yeah. Having spent a good amount of time thinking about businesses from, the owner's perspective, I think it affects the way I invest in bonds. It's natural for me to think about, the role the balance sheet plays in the business from an equity investor's perspective, and I don't lose sight of the fact that the balance sheet is a tool that equity investors use to create shareholder value. And so as a bond investor, you need to be focused on that reality. And I think that it leads me to, generally speaking, avoid investing in under-levered or lazy balance sheet situations. Every business has an optimal capital structure, like an amount of leverage that makes sense for that business. And there are many bonds out there issued by companies that have very little debt, and they tend to be high rated from a credit ratings perspective. And that can, be very comfortable for many bond investors. But to me, it's actually a source of risk. There's a lot of sort of untapped borrowing potential. And I would rather invest in companies where there's an amount of leverage that kind of makes sense, or even a little bit too much leverage, so that the company wants to delever, and then the interests of bondholders are aligned with the interest of owners in that situation.
So it must be interesting for a management company to see you and some of our fixed income colleagues walk into one of the meetings with the C-suite with our equity colleagues, because you sometimes will have different thoughts on your mind, and they have to give one version of the truth. The equity investors may be looking at the long-term growth potential of the common stock, and you may be looking at the ability to repay the loan. And so you're going in that meeting, and the CFO has to answer a question with both debt and equity holders in mind. Do you do a lot of those meetings still? I know you did as an analyst, as a portfolio manager. Do you still do a lot of those company meetings? And how are they different when both equity and fixed income investment professionals are in the room versus just one or the other?
Yeah, so I do not meet with nearly as many companies as I did as an analyst, but still occasionally. And you're right, having equity and fixed income investors in front of management at the same time sort of keeps them honest, particularly when we're talking about things like capital allocation or returning cash to shareholders, a company's thoughts around dividend policy. If a fixed income investor is in the room, they're going to have to be kind of less biased in the way they answer that question.
So I'm going to take you back to about 5 years ago, and I want your version of the story, because stories always change over time. But about 5 years ago, before I took my current role, I was leading our fixed income business, and you came in my office, and I was on the whiteboard, and we were talking about multi-sector income as a strategy. What's your version of the truth of our initial conversations on our multi-sector income strategy? Right now, you are the lead on that strategy. You're the principal investment officer in our terminology at Capital Group, but talk a little bit in your view on its origins.
Sure. So you messaged me on our messaging app, asked me to come over to your office. As I walked in, the whiteboard was to the right, and you had MSI kind of sketched out there. The
MSI, multi-sector income.
Multi-sector. I think we were initially calling it Flexible Income Fund.
We were. We were. Good point.
Today's MSI. And so, yeah, you had kind of the different sectors that you were thinking about for the strategy, thoughts around how big each sector might be relative to the others, thoughts around, flexibility, ability to make a sector larger, smaller, thoughts around PM structure. So you took me through it. And then you asked if you could hand it off to me and if I would be the principal investment officer. And I think I took, 2 seconds to say absolutely. And, from that day to now, I've probably spent, more than 80% of my time on multi-sector income. So it was a pretty significant day in my career at Capital.
Well, I remember the story largely in the same way. I think it was 1 second, not 2 seconds before you jumped on it. But I told you at the time that this would be different and we'll do multi-sector income different than our competitors. I think the words I used was that the world wasn't looking for yet another multi-sector income strategy, that we had to do something different for our clients to deliver differentiated long-term results. So talk a bit about the strategy.
Go back to that time before COVID. The yield on the bag was 2 something and had been in that area for many years.
So zero interest rate policy and a 2% yield.
Right. From like 2010 to 2018, 2019, that was the world that investors faced. And, I think we saw, literally millions of investors who have legitimate income needs that were struggling to generate income. And we observed, the various strategies that investors were using to try to find yield, and saw investors sort of creeping further and further out onto the risk spectrum, having very large exposures to single sectors, using leverage in many cases. And we looked at all of the resources that we have at Capital and Fixed Income, the individual sector teams that we have across so many sectors of the market, the macro research we have. And we saw, a better way to deliver elevated income without taking undue risk.
Right. So talk about the components of the strategy.
Sure. So we focus on, depending on the vehicle within the strategy, we focus on either 3 or 4 sectors. The 4 sectors are high yield corporates, investment grade corporates, emerging market debt, and securitized credit. And we size each sector sort of, very deliberately based on the diversity of investment options in that sector, the liquidity of the sector. And then we also sort of define the flexibility that we have relative to neutral weights for each sector to add to or reduce each sector as there are valuation dislocations and relative value opportunities change.
So for example, and again, it is a strategy in several different vehicles that clients can access, whether it's an ETF or a Lux fund outside the United States or a US mutual fund or an institutional separate account. There are different ways for clients to access that intellectual capital, and there's some different nuances between the different strategies. But I think by memory, about 75% of the neutral of the strategy are investment grade and high yield bonds.
That's right.
And so in those, how do you use them? How do you think of relative value between the two? And then take us in the room. You have a team of portfolio managers that you work with. You're the composer, but you have a team of partners you work with to generate the portfolio. Bring us inside that room and how you discuss how you should own the different sectors.
Sure. So we have a monthly meeting among the 5 portfolio managers that are responsible for the strategy. And we're also joined by an associate from our risk and quantitative solutions group. It's usually the last Friday of the month morning meeting. And we start the meeting with what this quant model that we use is telling us. So that we developed this quant model back in advance of the launch of the initial vehicle for the strategy. And we run it every day, and it is focused on spread differentials between the various sectors. So high yield spreads compared to investment grade spreads, high yield spreads compared to EM, high yield spreads compared to securitized, any sort of relative value relationship among those 4 sectors.
So the model is a point in time valuation comparison. Is one cheaper relative to its own history than something else, or more expensive to something else?
Correct. So we start the monthly meeting with what is the quant model telling us. And that's just supposed to be kind of a unbiased, here's what the data says. And it's a super important signal, particularly in bad markets. In a multi-sector portfolio, if let's say we're in a recession or some other crisis and, credit is weak generally, high yield and EM relative to investment grade and structured credit are going to be underperforming most of the time. And it can be kind of nauseating to add to sectors that like underperform every day. The model is there to sort of give us courage, to nudge us to add, to point out the fact that, look, high yield spreads are now really wide compared to all of these other sectors today versus history. And like we know that these are cyclical markets, that any crisis is eventually going to self-heal. And so the model nudges us to add. So it's not always useful to look at the model, but particularly in bad markets, it's a really important signal to pay attention to.
In some ways, it's a yellow sticky note that basically says, don't forget, it's getting cheaper. And then the five of you have a conversation. You have the ultimate decision in terms of asset allocation.
Right.
And so does everyone have a voice at the table? How does the conversation go?
Yeah. So after we look at what the quant model is telling us, we kind of go around the room. So we will hear from each sector specialist, portfolio manager, what's happening in that sector with credit fundamentals, what's happening with flows, new issuance, how many idiosyncratically cheap ideas is the analyst team in that sector identifying, and what's the magnitude of mispricing. Have that conversation about every sector. We also have the risk and quantitative solutions person who presented the quant model. That person is also going to talk about how the fund's positioned from sort of a risk perspective, thinking through the correlations between different positions. We're going to think about specific scenarios so that we can have kind of a better understanding of how the portfolio could perform in different market environments.
Well, I'm going to ask you one more question on the multi-sector income strategy before we pivot and talk about your broad investment career. But I will say in broad terms, so we don't have to have too many disclosures from our legal group, but in broad terms, you've done very well with the strategy for our clients. So thank you for your focus on that and on them. Why own a multi-sector income strategy over the long haul? I think our 20-year equity capital market assumptions would suggest that equity markets over a long term should do about 7% return. That's just our capital market assumptions. Fixed income theoretically should do lower than that. How do you think of multi-sector income as a strategy? Why would you own it? And how does that diversify broad exposure for people?
Yeah, I mean, I think it starts with income. Multi-sector generates an elevated level of income that, by virtue of the diversified and balanced approach we take, is more durable than it would be if it came from a single sector. We're talking about, on average, 250 basis points of credit spread over time, plus or minus. It's going to move around with market cycles, but that's kind of the average level.
So that spread over the risk-free rate gives you a yield of something in today's day and age of around 6.5%, 7%, something like that.
Right.
Over a 5 or 10 year time frame, this strategy could be comparable to our long-term capital market assumptions. Again, there are no guarantees in anything in life. We'll say that loud and clear, but on a risk-adjusted basis, this may be a very good part of a balanced portfolio.
I think it makes sense as a complement to a core bond allocation, standalone basis, a broader portfolio that has equities and fixed income. So many investors have an income need.
All right, there's no better halftime between multi-sector income and Damien as a long-term fixed income investor than bowling. So I'm going to go into our office treasure hunt. You mentioned that instead of ending up at the bowling alley, which would not be a terrible career, but instead of ending up there, you ended up here. And that doesn't mean you didn't have a great interest in bowling. So what I'm holding in my hand for those who are listening, the viewers can see it on our screen. For those who are listening, it says 11 in a row, Damien McCann, and it looks like I'm not a bowling person, so I'm going to ask you to expand on this. But it looks in 1996 that you bowled a 296. I do know 300 is a perfect score. So I'm going to ask you to hold this for a second and talk about that. It's in your office, so it's important to you. Tell us a little bit about your bowling background, and do you still own a bowling ball today?
I do, and more than one, actually.
Okay, and more than one. I didn't see that coming. All right, so tell us a little bit about it.
Sure. So my first job in high school was working at the local bowling alley. And one of the perks for all employees was free bowling, unlimited. So there were a couple summers when I was in high school when I sort of lived at the bowling alley and bowled a lot. And I got pretty good. And there was a time when I aspired to be a professional bowler. Quickly learned that it's brutal making your living as a professional bowler, so I chose to follow a different path. But there was one night bowling in a league where I threw the first 11 strikes, and you do need 12 for a perfect game. This is in the bowling world, a 296 is actually slightly embarrassing because usually when you have the first 11 and you don't shoot 300, you shoot 298, 299, you hit the pocket, you left a 10 pin. Happens all the time. 296s are actually rare. So I totally choked. I did not hit the head pin, but it was a good memory.
Well, I'll tell you from someone who has bowled about 3 times in his life, I've had many experiences in my short bowling career where I didn't hit anything. So well done on 11 in a row to start, and very glad that you ended up here and not at the bowling alley, because you're making a big difference in what we do. All right, I'm going to take a pivot here. I want to talk about lessons you've learned over time. And this is the humbling part of the conversation in what's a humbling industry. But you were a relatively new analyst heading into the global financial crisis. It was jarring, to say the least. Is it that time that gave you your biggest experience or lesson learned? Like, where would you say that came?
I think so, yeah. I mean, I had been following energy for 2 to 3 years at that point. I had recently picked up lodging and cruise lines shortly before the crisis began. So it was a jarring event that was brutal for most investors, but it did lead to some really important lessons. I can remember in my investment grade corporate research portfolio, I was focused on BBB rated midstream companies because I could get an extra 20, 30, 40 basis points of spread and yield compared to higher quality A-rated midstream companies. And I thought that made sense to do. I was comfortable with these companies, their assets, the way their balance sheets were managed. But I had my blinders on about the potential for severe volatility and drawdowns.
What could go wrong?
What could go wrong? And so when the crisis broke out and got to the point where the capital markets kind of stopped functioning, the BBB rated pipeline companies with more leverage had a high reliance on continuing functioning of the capital markets. And so those bonds got destroyed. And they dramatically underperformed A-rated pipeline companies. And so I didn't have any flexibility at the depths of the crisis because I had so much kind of beta and higher volatility credit heading into it, as opposed to, and this is sort of the lesson, I should have been more balanced. I should have been, not completely ignoring the higher quality parts of the market, trying to find the best relative value in higher quality cohorts at the same time that I'm finding the best relative value in lower quality cohorts. That would have had me in a position to sort of add risk at the bottom and try to step into some securities that had gotten really cheap, and I didn't have that flexibility. So I think that's in all crises, there are incredible investment opportunities that are created by the crisis, and you have to have the capacity in a portfolio to step into those because it's transformational for long-term returns if you can, and if you can't, it's painful to forego those opportunities.
Yeah, it's interesting because back to when we had that initial discussion of would you take on this multi-sector income strategy as a principal investment officer, one of the reasons you made such a good candidate is you had that lived experience. You saw that volatility, you understood relative value, you understood diversification, but it came out of a really difficult environment. So it made you a better investor today, I'm sure. Today, what is your investment edge? What do you think you do? And I mentioned your solid results versus competitors versus benchmarks. You've done well over your career at Capital Group. What is it that leads to that outcome?
I try to be very disciplined on valuation, both at the sector level and at the individual bond level. So every bond that I decide to hold in a portfolio, I want to have a view of what it's worth. And then I'm going to closely track where the market actually trades it compared to what it's worth. And I want to have as many sort of cheap bonds in the portfolio across the risk spectrum. So, not just lower quality cheap bonds, but higher quality cheap bonds as I can, and sort of continually prune the portfolio to improve its relative value over time. So I would say that's one part of it. And then people tell me that I have a steady hand. If you could see what's going on in my head when we're in volatile markets, It doesn't always feel that way, but I guess there's some truth to that. And I think it's like I'm mostly an optimistic person. Like that's usually how I come at things, which investing in credit over the long term, I think is a good approach. But I've also learned, that you should have kind of bridled optimism. You should look over your shoulder. It makes sense to be a little paranoid. And so, it's just kind of the balance of a little paranoia and optimism that I think serves me well. So just sort of like legging into positions gradually, I think helps.
So some of our fixed income portfolio managers sit in offices and some sit on the trading desk. You're a trading desk person. You are always there. Anytime I'm walking the halls, I see you there. Why do you sit on the trading desk?
I feel like I have an advantage listening to the many conversations that are happening around me. So I tend to sit in the investment grade row, but the row, 15 feet away is the high yield row, and I can hear the conversations happening there, just like I can hear the investment grade conversations. The rates group isn't far away, so I just feel like I can make better decisions in a portfolio by hearing different perspectives kind of continuously throughout the day from different sectors, because these sectors are very distinct from one another, and directionally they can be moving very differently.
So long-term investing, but short-term immersion into the conversation of what's happening across different sectors.
I think that's right.
Okay, you are. We talked about long-term, and in our core values at Capital Group, one of our 5 core values is long-term. You married your 8th grade sweetheart, and that's long-term. I think in 8th grade, you're probably about 14 years old-ish.
Yep.
So you've been together for a very long time. I'm going to ask you to talk about that. And I can't remember before we walked in if we talked about whether or not you wanted to talk about family, but now you're in it. So
I'm in it.
Jump in.
Yeah, well, we actually met each other. She came to my elementary school in the 4th grade. We were boyfriend and girlfriend for 6 months in the 8th grade. We then graduated. The school ended at the 8th grade. We went our separate ways to different high schools, remained friends. Yes, I should mention, she broke up with me at the end of 8th grade. But
For good reason, or is it just one of those 8th grade things?
It was one of those 8th grade things. But yeah. I basically never got over her. And so years later, we were going to the same. Before I went to Cal State Northridge, I went to Moore Park College, a community college near where I grew up in Simi Valley, and she grew up in Moore Park. So we were both at Moore Park Community College as friends, and then eventually got back together. And I proposed shortly after, and here we are many years later.
That's great. When you're not on the desk, immersed in all the conversation between all those different sectors, what do you like to do for fun?
My wife and I go out to dinner a lot. We go to Dodgers games. We go to sporting events that our kids, my youngest daughter is a volleyball player. My son is a baseball player. We'll occasionally bowl as a family, those sorts of things.
So we're going to see your son on the Dodgers?
According to him, yes.
According to
he
him,
will be
yes.
there.
So just coming off a World Series victory, give us the prediction now. Are the Dodgers going to win the World Series again? Are they going to repeat in 2025? Yes or no?
I'm going to call it. Absolutely. It's a dynasty.
Wow. Okay. No hedging going on there. Last thing I want to ask about Capital Group, and then we'll get into our obsessively grateful moment, is mentors. Everyone talks about folks who had a real impact in the career. You already mentioned one in that shift from equities to fixed income, but give us another mentor who made a big difference in your investing career.
I would say David Barclay, who is retired, was a high yield manager. He taught me the value of double Bs. Double Bs in the high yield world, they don't yield as much as single Bs and triple Cs, but they have dramatically lower default rates and they hold up much better in bad markets. And so you can actually generate pretty good returns that are competitive oftentimes, not always, but oftentimes with a broader high yield portfolio. And it just kind of gets to the balanced approach that I take, having exposure in a high yield portfolio to double Bs. When spreads widen, it allows you to pivot to higher risk things, the reduced exposure to the double Bs that did really well, and go after some higher return opportunities. So I really like investing in double Bs. And
so double Bs are a little bit like that baseball player who hits singles and has a relatively high batting average, but doesn't hit a lot of home runs.
Sure.
Ish. Okay. Maybe not. Well, David Barclay was a great investor at Capital Group for a long time, and I'm sure he'll appreciate that shout out. And he did teach a lot of people a lot about investing. Last but not least, we're going to talk about what you're grateful for. And just as a reminder for folks, we have done this since our very first podcast where we've met with our portfolio managers. And the impetus was really around making sure we remind ourselves how grateful we should be. In, day out life, we all have a list of things that are annoying us, that are on our mind, that are causing stress. And there's also this other list that we don't pay as much attention to, and that's of the kinds of things we should be grateful for. So we added this segment in the first session with Rob Lovelace. We've done it every time since. We have these fancy mugs that say, "Be obsessively grateful." Find one on eBay. But tell me what you're grateful for, and I will hand you your mug at the same time.
Okay. So there's actually two things that I'll mention. The first is that our oldest child, Lexi, who is 18, who just started in college, she's off to a great start, and that makes me really happy. And then my son asked me to take him to a Billy Joel concert a few weeks ago in LA. How cool is that?
That's really cool. Are you a Billy Joel fan, or you are a Billy Joel fan? Good. Well, I'll tell you what, seeing Billy Joel at Madison Square Garden, there are a lot of folks who had the opportunity to do that and see him elsewhere, and what a great show he still puts on. So glad you were able to do that. Thank you for joining us. I think your view around multi-sector income, how income is so important in a balanced portfolio, and how you and our team do it in a different way is critical. We appreciate what you're doing in that strategy globally for our clients and for your almost 25 years at Capital Group. So thank you, Damien. Thanks for joining us, and please subscribe to Capital Ideas on YouTube or wherever you get your podcasts. Have a great day.